In the last couple of videos, we covered two key points. Iran sent a proposal through Pakistan, and then Trump publicly said he wasn't happy with it. Today's update is the fallout. We are looking at what happened after that rejection and why the market reacted instantly, especially oil and gold. The shift was immediate and intense. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. So here's the new headline that changed the tone. Iran has now sent its response to the US peace proposal through Pakistan, and the US side, Trump, has rejected that response as unacceptable. This is not just politics. For markets, this is a direct signal that the deal probability just dropped, at least for now. Uncertainty is back. When deal probability drops, investors pull back. They move capital away from risk and toward assets that protect them from geopolitical shocks. And when deal probability drops, the first thing that happens is oil starts pricing risk again. The premium for uncertainty is added back to every barrel. The Strait of Hormuz is still the real pressure point. Geography is the one thing diplomacy hasn't changed. Every tanker through that strait is now under a microscope. Now, why is this rejection such a big deal? Because the whole negotiation story was leaning toward a phased approach. It was a step-by-step roadmap to stability. The plan was, first calm the conflict and stabilize shipping, then tackle the bigger issues. It seemed straightforward on paper, practical and manageable. Iran's response was basically leaning toward prioritizing hostilities and safe passage first. They want a guarantee that their shipping is untouched before anything else, while the US has been pushing harder on the nuclear side and longer-term terms. This fundamental gap, nuclear oversight versus shipping security, is the friction point. When the US rejects the response, the market reads it as, okay, the timeline for stability gets pushed out. The near-term solution is now a long-term hope. This push-out means shipping risk stays in play. Insurance companies, freight operators, and fuel buyers all have to adjust for months of potential disruption. And today we also got another shipping-linked development that matters. There's a fresh wave of focus around maritime incidents in and around Hormuz. Specifically, the South Korea angle. South Korea condemned an attack on a cargo ship connected to a Korean operator. This shows it's not just a two-country issue. They publicly said it would respond once responsibility is identified. The more countries publicly get involved, even diplomatically, the more the world treats Hormuz as a danger zone. Perception is everything in these markets. If the world perceives the strait as dangerous, the economic cost is the same as if it were actually closed. The cost is real, and that's the core reason oil doesn't relax easily. The threat to physical flow is the only thing that actually drives this market's fear. Everything else is secondary. So here's the current reality. In one sentence, the ceasefire may still exist in official language, but on the ground, the situation remains fragile. We are on a thin line. Shipping security is still not fully normal, and diplomacy is still not landing a final agreement. It's an expensive stalemate in motion, costing millions in daily delays. That's why markets are still trading this story like a live risk event. There is no all-clear signal for the traders yet. Volatility is the only constant. Now let's talk markets properly. Oil first, because oil is the cleanest signal of geopolitical tension we have. It is the most honest indicator of real-world risk. Oil moved up today for three simple reasons. These pillars define the current price action and tell us where the market is likely headed next. First, the rejection headline. When the US rejects Iran's response, traders immediately increase the probability of disruption lasting longer. Risk is extended. The moment that happens, the risk premium gets added back into crude. You see the price jump before the news even finishes breaking. It is instantaneous and powerful. Second, the Hormuz reality. Even if there is ceasefire wording, the strait is still a choke point. That geography doesn't change with a headline. It's a physical constraint. The market is watching not just military headlines, but shipping insurance, freight rates, and safety warnings. These are the lead indicators for price movement. When the strait is tense, oil doesn't need full war to rally. It just needs uncertainty about flow. Uncertainty is the fuel that keeps the price elevated. Third, the incident factor. During this type of conflict, oil doesn't move like a normal supply-demand market. It moves like an insurance market. It's about hedging. One shipping incident can reprice the entire week because traders are forced to price worst-case risk even if it doesn't happen. It's about protecting against the what if. Now, what levels should we expect today? I'm going to explain this in zones so you can adjust your strategy anytime as the news breaks. Stay fluid. Right now, oil is trading around a psychological pivot zone. The 100 area for Brent is still the main battlefield. Above it, we are in crisis mode. When oil sits around that zone, the market is basically undecided. Is this going back to normal, or is it preparing for another spike? It's a high-stakes tug-of-war. If Brent holds above the 100 zone and keeps finding buyers on dips, the market is saying the risk premium is sticky. That keeps the bias bullish. Spikes can happen quickly. One headline is all it takes to send it through the roof. In that scenario, liquidity vanishes and you have to be ready to act fast. If Brent loses that zone and starts accepting below it, then the next magnet becomes the mid-90s area. That's where deal optimism selling usually takes it. But you only get sustained weakness if the news flow supports stability, meaning fewer incidents and real shipping normalization. We aren't there yet, not even close. On the upside, if we keep getting escalation headlines, a confirmed ship hit or new drone incidents, oil can spike into the low 100s again in minutes. And if a major incident hits, then the market starts talking about the upper 100s area. We have to be prepared for that extreme tail risk volatility. I'm not giving a fixed target, because in geopolitics, you don't trade targets, you trade triggers. The trigger is always physical flow. Is the oil moving or not? So today's oil playbook is simple. If news stays negative, oil stays supported and can spike. If we get a peace headline, the premium will unwind violently. Now let's shift to gold, because gold did something very important today. It weakened even while the conflict risk is still alive. This is the anomaly we must solve. Gold is falling today mainly because oil rising creates inflation fear. That's the link most people miss. It's a battle between fear and interest rates. Inflation fear strengthens the idea of rates staying higher for longer. When the market expects rates to stay high, gold, which doesn't pay yield, gets capped. Yields remain supported, and that makes holding gold more expensive in terms of opportunity cost. It's a fundamental headwind that's hard to beat in this climate. This is the key lesson your viewers need. Gold right now is not a simple war trade. It is a war trade fighting a rates trade. Two powerful forces in conflict. One force is fear and uncertainty that supports gold. The second force is oil-driven inflation fear that pressures it. Today, the inflation fear is winning. Inflation fear also supports the dollar, and that pressures gold even more. That's why gold can look weak on a scary news day. It's about the dollar's power. Now, levels for gold today? Again, I'll speak in zones so you can map out the movements regardless of the specific hour. These are your tactical boundaries. Gold is rotating around a pivot area in the mid to upper 4600s and 4700s. That zone decides the trend for the next few days. That zone matters because it's where the market decides whether it's in pure risk-off mode or in a yields-dominate mode. It's a tug-of-war for the narrative. If gold can reclaim and hold above the 4700 pivot, then bullish control returns, and the next upside test is the 4750 zone. Catalyst needed. That move usually needs either a big escalation shock or a strong risk-off wave in equities. It needs a reason for fear to completely take over the room. If gold fails to regain that pivot, then the downside pressure stays active, and the next support is the mid-4600s. After that, we watch the floor. If that breaks, then you watch the 4500 psychological zone. That's where the real buying interest should reappear. It's the ultimate floor for now. What would make gold break upward strongly? It needs a shock that overwhelms the yield effect, something that makes interest rates irrelevant for a moment. For example, multiple ships hit or a clear sign the ceasefire framework is failing regionally. That's when fear becomes dominant and gold can rally despite yields. What keeps gold weak? Oil staying elevated keeps inflation fear alive, and that keeps yields supported. It's a self-reinforcing trap for gold bulls. Watch the ratio. In that environment, gold becomes choppy and heavy. It can bounce, but it struggles to trend. Don't chase the fake outs. Stay patient for the real signal. The big relationship today: oil up, gold down. Why this combo matters is the master key to understanding the market mindset right now. It's about dual fears. Oil up means supply risk is being priced. Gold down means inflation and rate expectations are capping the safe haven. It's a battle between danger and math. So the market today is not saying war is over. It's saying we fear disruption, but we also fear inflation. Both are equally scary to investors right now. This is exactly why trading is hard right now. Both commodities are reacting to the same news through different channels. You must watch the cross currents. Now, let's look at the India impact, specifically only what is new today. I won't repeat the old chain. Let's look at the duration risk for the Indian economy. What's new is this: because oil popped again after the rejection, the market has to reprice the probability that oil stays elevated for longer in India. Hope is fading. That alone brings back pressure on India's macro story, especially currency sentiment and inflation expectations. It's a direct hit to purchasing power. So the only India note you need today is, if crude stays supported and straight headlines keep coming, it becomes harder for India to get clean relief. Period. No shortcuts. That means sectors sensitive to fuel and input costs remain vulnerable. Watch the logistics companies and manufacturers closely. They are the canaries in the coal mine. Now let's end the video with the most important part. What happens next? I've identified 3 specific triggers you must monitor every single day. Vigilance is key. First, the diplomatic trigger. Do we get a revised response or a formal meeting? Right now, it's just indirect posturing. A direct meeting will flip the market instantly. Second, the shipping trigger. Do we get a confirmed vessel hit or a major safety warning? This is the fastest, most brutal trigger for oil spikes. It is binary. It's the single most important risk lever in this story. If a ship gets hit, the entire market map changes in minutes. Retail traders get hurt here. Stay alert and use stops. Third, the escalation trigger. Rhetoric is one thing, but action is another. Any confirmed escalation beyond shipping pressure flips the market to total risk of panic. So your takeaway is simple. We're in a phase where diplomacy is active, but not successful enough yet. The ceasefire framework is being stress tested. Limbo is expensive. Oil is reacting as a shipping risk market, and gold is being capped by inflation fears pushing yields higher. Understand this and you understand the pulse of the economy. And today specifically, the big reason markets moved is Iran sent its response, Trump rejected it, and that immediately increased the probability of a long delay. Flow is king. Stay informed, stay objective, and I will see you in the next update as this story continues to unfold. There is much more to come. Stay tuned to the data. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step in a way that feels practical and manageable. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos.